On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Happy New Year, everybody. That's it. 2023 is done and dusted. The year is behind us. Markets have all closed, so we can now look back on what was a sometimes challenging, definitely eventful, but ultimately quite lucrative and prosperous year. I thought I would just jump on here and share a few thoughts. I'm just going to pick 5 key events from 2023, and we're going to run through those. The first one was inflation coming down much quicker than expected. When we started the year, at the end of 2022, start of 2023, we were facing very high inflation, but that did come down much more quickly than expected last year, and we now sit here on the cusp of 2024 beginning, and we're in a much better place. We hope those declines continue, but so far so good. Here in New Zealand, we're probably one of the outliers. We don't get our information as regularly as other markets, so our inflation rate's still sitting at 5.6%. That's lower than many expected it to be. It's lower than the 30-year high or 32-year high, I think it was, of 7.3% that we saw this cycle. And it will come down. In January, we will see some fresh numbers, and I expect those to point to inflation falling. Similar story elsewhere, but we have seen inflation rates that started out even higher come down more aggressively. So in the US, we've seen the headline inflation rate come down from a peak of 9.1, which was the highest since the early 1980s, right down to 3.1% at a headline level. And if you look at the core PCE, which is the inflation measure that the Federal Reserve likes to watch very closely, they think it is a very good gauge of the true price pressures out there. The average of the last 6 months is running at an annualized rate of 1.9%, which is actually just below the Federal Reserve's target of 2%. So fantastic what we've seen in terms of those inflation rates coming right down. Europe and the UK, similar story. Both of these regions or countries saw inflation that was in double digits, 10.7, I think the European inflation rate got to in 2022. In the UK, 11.1. A lot of that was in the wake of the Ukraine invasion at the time, but those have come right down. We've now seen European inflation come down to 2.4, and we've seen UK inflation come down to 3.9. So very much moving in the right direction. On the back of that, we've seen some big moves in interest rates throughout 2023. Interest rates pushed a lot higher, and then they fell back sharply through the back end of the year. So if we look at central bank interest rates, the New Zealand official cash rate started the year at 4.25, ended the year at 5.5, and in the eyes of financial markets and many commentators, including myself, that will be the top, and from here we'll see declines, but it was still a big move from the beginning of the year to the end of the year. In the US, the numbers are very similar. The Fed funds rate, or the upper bound of the Fed funds rate, because the Fed does a range rather than a specific point, that increased from 4.5 to 5.5. So again, expected to be the top. That saw some big moves in bond yields and wholesale interest rates and in the yields on fixed interest securities and government bonds that are traded across markets. In the US, the 10-year bond yield, the 10-year government bond yield that is, started the year at 3.9%. It went as low as 3.25 in April. That was during the regional banking crisis. And then it went a little above 5% in October. That was the highest we'd seen since 2007, 16 years ago. And then it came down through November and December, and it actually finished the year pretty much exactly where it started, back at 3.9. But what a roller coaster on the way through. Our 5-year swap rate, which is a wholesale interest rate, also moved around a lot. It started last year at 4.86%. It rose to a 13-year high of 5.4% in October, I think it was. That was the highest we'd seen since 2010. And then it finished the year at just below 4.1%. So a big move in those last 2.5 months of the year, coming right back from 5.4 down to 4.1. So that was number two. Interest rates surging and falling back quickly. My third event of the year was the return of the 60/40 portfolio. It was a really good year across the board for investors, despite all the doom and gloom. You had fixed income returning 7.5%. That's the first positive year in three, the best year since 2014, and it's easily above the long-term average, which is about 5, maybe 5.5%. 7.5% from fixed income, that's income and changes in the value of fixed income securities, so it's a total return measure. 7.5% is not bad at all. New Zealand shares, not quite as good as that. The NZX 50 index returned 2.6%. So New Zealand shares sort of went sideways. So that's better than the last 2 years, because the last 2 years the NZX 50 has been down. And 7 out of 10 stocks in 2023 were still up. So it was far from a terrible performance. It's just that most of our bigger stocks sort of meandered through rather than sort of delivering the returns that we became accustomed to in the years leading up to that period before COVID, but still well below the long-term average. Long-term average from New Zealand shares is about 8.5 to 9%, including dividends. So a little bit disappointing compared to that, and also disappointing compared to what we saw from other markets around the world. You saw global shares really rocket ahead. Let me just find my stats. Apologies, bear with me. Japan and the US, they were the two standouts. Japanese shares up 27.8%, US shares up 26.3%, Europe was up 18.5%. Across the Tasman, the Aussie market up 12.4%, emerging markets 10.3%, UK shares 7.9%. So all of those numbers are well above what we saw from the local market, 2.6%. And it was all New Zealand assets that really did languish. Listed property performed a little bit better than the broader market. Listed property was up 5.5%, but house prices pretty subdued too. House prices rose 1.5% this year. So if you were to draw a chart, and I posted one on LinkedIn, so go and take a look at it, you will see that it's all the New Zealand asset classes that are dragging the chain, which is quite interesting. That's all in local currency terms, and it all includes dividends, by the way, just so it's apples with apples. But in terms of currencies, there were some movements there that would have had an impact on the returns New Zealand investors received. Currency moves would have boosted the return from European shares and UK shares quite substantially. Currency moves would have dented the return of Japanese shares by quite a bit, and they would have been largely irrelevant for US shares and Australian shares. We didn't really end the year. We ended the year little changed against the US dollar and the Aussie dollar. So it was a bit of a rebound for the typical 60/40 portfolio. And the reason I sort of raised that is through 2021, 2022, there was a lot of talk that, that typical traditional way of investing no longer works, and it'll never work again. I never bought into that. That was a really foolish way to think, in my opinion. I think it was just that both bonds and shares were overvalued through that period, so they were never going to work again. until they fell to a point where they became reasonably valued. And that has obviously happened now, which is why we had a good year in 2023. But someone with that traditional 60-40 portfolio, so it's 60% shares, 40% bonds, and for argument's sake, I'll say the bonds are all New Zealand bonds because that's what most New Zealand investors do. Just buy the local bonds, better yields, and for the shares, let's just keep it simple and say half of those shares were New Zealand shares and the other half were international shares, there or thereabouts. So someone that did have that 60-40 approach probably did about 10% in 2023 in terms of their return, give or take. And then if you take off fees, call it 1%, that's usually a reasonable approximation for the fees that you would have to pay to get someone to manage your portfolio and provide you, some a tailored service. Then you're looking at a portfolio return of about 9%, which is pretty solid. Not bad. The average over the last 20-25 years for a balanced portfolio, something in that sort of 60-40 split range. Probably more like 6 or 7%. So 9%, not terrible. So that's three. We've had inflation coming down. We've had the roller coaster that was interest rates. We've had the return of the 60-40 portfolio. The last two, the dawn of AI, really pushing tech stocks higher. That was a really big theme of 2023. When you look at the S&P 500, and it was up 25 odd percent, a little more if you add dividends in, like I did earlier when I was quoting those returns. But what's really interesting is that there were three key sectors that drove the S&P 500 in the US higher. Technology, up 56%, communication services, up 54%, and consumer discretionary, which was up 41%. Now, those three sectors are where all the big tech stocks live. The technology sector itself has the likes of Apple. Communication services has Facebook, which is now called Meta, and Google. Consumer discretionary has Amazon, and you've obviously got Nvidia and the other stars as well. So those three sectors really drag things up. Nvidia was the top performer of the year. That's the chip maker. So more AI means more computing power is needed, which means you need these really grunty chips and everything, and Nvidia really benefited from that. They were the top performing stock in the S&P 500, up 239%. So a great performance there. Meta, which used to be called Facebook, it's now called Meta. It was number two, up 194%. But when you look at the return from the other 8 sectors across the US market, there's 11 sectors in total. Take those 3 superstars out, look at the return from the other 8. They were much more subdued. The average return from those 8 for 2023 was just 3.5%. So there's a couple of lessons there, isn't there? One, you had to have an exposure to some of those star tech stocks, some of those companies that the market saw as being leveraged to that artificial intelligence theme. Otherwise, you would have been left behind. So that's another nod to diversification. And there's plenty of examples throughout 2023 of why we need to diversify. And also, guess the second lesson there, when you look at that diverging market performance, is that there is still a lot of reasonably priced opportunities across the rest of the US market. Even though the index is up 25, 26, 27%, remember it has been driven higher by a relatively modest group of stocks and sectors. So you just need to hunt around a bit more for good value opportunities if that's what you're looking for. If you're trying to avoid some of those ones that have had such a strong run, I wouldn't avoid them completely because they could continue to perform well if the AI theme does prove to be as exciting as many people think. But if you are looking for something that looks more reasonable in terms of its valuation, there's plenty of opportunities out there. Number 5, and we can't talk about 2023 without conflict that has re-emerged in the Middle East. I say re-emerged because it's a part of the world that has always found itself with wars and conflicts and violence, sadly. Markets have largely shaken off what we've seen in recent months in the Middle East. Oil actually finished the year down 10 or 11%. It's sitting at about $72 a barrel. So we haven't seen huge ramifications across financial markets. We obviously want the fighting and the violence to stop for obvious reasons, just because it's terrible what we're seeing over there. But in terms of flow-on effects into financial markets, they've been fairly limited, and I think that's because you haven't seen it broaden out and draw other countries or other groups into the fighting. So that is still something we need to watch closely. Hopefully, it doesn't escalate. Hopefully, it calms down. But oil down 11% over the year. Gold actually had a good year. Gold was up 13%. Now, I don't think that's really reflective of nervousness around geopolitical risks. I think it is probably more to do with expectations of rate cuts in 2024, as well as some weakness in the US dollar late in the year. High interest rates aren't fantastic for gold because it means the opportunity cost of holding gold, which is a non-yielding asset, it doesn't give you any income, go up. If you can get sort of 5%, 6% in a money market fund or in a bond, you can get sort of 4 or 5% in a US government bond. There's less reason to own gold or more alternatives to gold. So high interest rates can be a handbrake and a headwind for gold, and because the expectations that they're going down have come into the mix in recent months and weeks, gold has increased in value. And I think the US dollar as well. Gold's obviously priced in US dollars, so when the US dollar has been weakening, the gold price goes up, sort of, because one offsets the other. So that's where we're at. That's 5 things that caught my eye throughout 2023. There's plenty more that happened in between times. We'd be here all day talking about them, but nobody wants that, so we'll leave it there. If you do want to remind yourself how 2024 might be shaping up and the sorts of things investors need to be thinking about, I recorded an episode in early mid-December. It's still very much current in terms of the themes and the concepts, even if a few of the numbers have changed. So I would encourage you to revisit that. And over the next couple of weeks, I have got a few other things that I want to talk about. So you'll hear from me again very soon with some additional thoughts about what we should be pondering as we look ahead to 2024.